Okay. I see people are still filing in, but we're gonna get started. Kevin and Shifra, you ready?
Ready?
All set.
Ready. Perfect. Great. Good morning, everybody. Happy New Year and welcome to the Shenkman Private Client Group Accountant Attorney Winter Webinar Series. This program is entitled Estate Planning in 2021, How the Results of the Georgia Senate Runoff Election Will Impact Planning in an Uncertain Year and Other Timely Topics. For those of you who don't know me, my name is Jonathan Shenkman. I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer, based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 15 to 20 events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. My most recent piece is an op-ed published on CNBC entitled Investor Alpha is the Most Important Financial Strategy for 2021. After the program, I'll send out a link to this piece and a variety of other periodicals where I publish my work. Today, we'll be covering how the results of the Georgia Senate runoff election will impact planning. Until last Tuesday evening, many practitioners across the country were convinced that we would have total gridlock in Washington, which would have meant little change in terms of tax policy. However, continuing with the theme of 2020, the unexpected happened, and we had a Democratic sweep. This means the Democrats now have a slight edge in both the House and the Senate. To discuss what this means for estate and tax planning in 2021, we have two distinguished panelists here today. Kevin Matz and Shifra Herzberg, both from Stroock and Lavan LLP based in New York City. I'll give both Kevin and Shifra some time to discuss their respective practice areas, but just a brief introduction to start us off. Kevin is a partner at Stroock where he concentrates on domestic and international estate and tax planning, estate administration, and related litigation. His practice primarily involves advising high net worth individuals, wealth transfer planning, income and generation skipping, transfer tax planning, charitable giving planning, probate proceedings, and estate administration. Kevin is also a certified public accountant. Super Lawyers has recognized him 2 years running as a rising star. He's also recognized by Best Lawyers in America and is a prolific speaker and author. Shifra is special counsel at Stroock, where she focuses on sophisticated estate planning, estate administration, and business succession planning for high net worth individuals. She drafts customized documents for clients to dispose of their assets in a tax efficient manner that achieves their personal objectives. Shifra was recognized by Super Lawyers as a rising star in 2019. I've had the privilege of knowing both Kevin and Shifra for some time, and we all serve on the Trust and Estates Committee of the UJA Federation in New York, where Kevin is the chair. Before we jump into the meat of the presentation, if you can each take a minute or so to tell us a little bit more about your practice and the type of clients you work with. Kevin, how about we start with you?
Well, thank you, Jonathan, and good morning, everyone. You pretty much covered it. I would just say I work with high net worth individuals and families, very much involved with a number of organizations that are very near and dear to me. They include American Trust and Estates Council, Apter, New York State Bar Association, where I'm a co-chair of the Tax Committee, the Trust and Estates Law Section, New York State Society of CPAs. As you mentioned, I'm also a CPA. It's just a wonderful, wonderful organization. AICPA, New York City Bar Association, as you mentioned, UJA Federation of New York, the Trust and Estates Group, where we all serve together.
Thank you. And Shifra, anything you would like to add?
I think you covered most of it for me as well. I work with Kevin at Stroock, sophisticated clients, high net worth individuals, and do their estate planning, estate administration, charitable planning, marital agreements, all of that kind of thing. But thank you so much.
Great. Thank you for that. And now let's jump into the topic at hand. Both of you can feel free to share your thoughts on each question. The first one is, what is the potential impact of President-elect Biden's election and the Georgia Senate runoff elections on estate planning?
I guess I'll take that first. And Jonathan, you pretty much set the stage. So we find ourselves, and we did not know this. We did not know this would happen until January 5th, which is what a week it's been, right? But exactly 1 week ago, or in the wee hours of January 6th, we had the Georgia Senate runoff race, and as a result of that, you had Raphael Warnock and John Ossoff win the two Senate seats in the runoff in Georgia. As a result of that, it's now 50-50 in the Senate. And of course, 50-50 with Kamala Harris as vice president be able to cast the tie-breaking vote. So what does that mean? It means that the Democrats, we find ourselves with a very delayed, but nonetheless, a blue wave. The Democrats control the Oval Office in another 8 days. Today is, by the way, if this is recorded, is January 12th, so 8 days from now is January, it will be January 20th, Inauguration Day. And both houses of Congress, House of Representatives, and then by the slimmest of margins, 50-50 with a tiebreaker via Kamala Harris in the Senate. Now, it's interesting. Does that mean that there's going to be effectively a manifesto for very progressive tax policy pertaining to income taxes and also with respect specifically to estate planning? I'm not so sure about that, because if 50-50 is the thinnest of margins, what does that mean in order to pass legislation via the Democrats? You have to have unanimity. And I think it would be a mistake to view the Democrats in the Senate as a monolith. For example, you have moderates who almost borderline conservatives, such as Joe Manchin, senator from West Virginia. So you hear things about retroactivity, and we'll talk about that later, and the possibility that laws could apply retroactive to January 1, 2021, and tax law changes, and reductions and exemptions, and increased rates, and the like. There's constituency that has to be reported to as to all that, and I don't see the moderates necessarily supporting that. They may support prospective legislation. Over $3.1 trillion was spent in 2020, allocated in 2020 alone, by virtue of the CARES Act and relief due to the COVID-19 and coronavirus, which we're starting to see the light at the end of the tunnel because of the vaccine, but still many months away. It's as simple as that. So there will be further aid, and it needs to be paid for somehow. But my sense is probably, and we'll probably talk about this a little bit later, probably not going to see retroactive legislation, although it is theoretically possible. Again, unlikely. I just clicked something inadvertently on my computer. Okay, I'm back. So what are the proposals that were part of the Biden platform? Just to summarize them briefly, and then I'll drill down on some other items that could be addressed as well in the coming year. So starting on the income tax side, we had basically a proposal, part of President-elect Biden's proposed tax policy. It included raising the top individual income tax rates for those making over $400,000 a year from 37% to the pre-Tax Cuts and Jobs Act rate of 39.6%, and also raising the top corporate rates from 21%, the present level under the Tax Cuts and Jobs Act, enacted again in 2017, to 28%. Secondly, proposal to increase the tax on long-term capital gains and qualified dividends up to 39.6% for investors with income over $1 million, which is nearly double today's top rate of 20%. We may talk about qualified opportunity funds and opportunity zones later on. That is basically a way to defer one's capital gains, kick them all the way down the road potentially to after 2026, and maybe have some of the gains eliminated and possibly have further exclusion. That becomes that much more attractive than the current environment, because the value of deferral, if capital gains rates go up, become that much more significant. Also, possibly a 28% cap on the value of itemized deductions and a reinstatement of the phase-out of itemized deductions that was eliminated under Tax Cuts and Jobs Act, the so-called PEAS limitations. Now, moving over specifically to estate and gift tax, we know that there's one of the bedrock principles is that unless there's so-called income in respect of decedent, think qualified retirement plans, IRAs, and the like, for the most part, there's a step up in basis upon death to fair market value at death or at the so-called alternate valuation date, which could eliminate, let's say you have massive appreciation of holdings in marketable securities, Google stock, Apple stock, Microsoft and the like. All that gain could be does get eliminated at death under current law. There's a proposal in the Biden plan that would eliminate that step up in basis Now, how would that manifest? There are a couple of different ways that could manifest, and this is not clear. This is as clear as mud, as they say. One is to basically do what Congress did back in what was enacted back in 2010, the year without the estate tax, or at least optionally the year without the estate tax. And the way that worked was that there was a modified carryover basis regime, no step up in basis except for certain limited amounts. We could see that. Or there could be something similar to Canada, which is death is a realization event, a recognition event, and whatever capital gain there is, subject to certain exclusions and limitations, it gets harvested and recognized upon death. Now, I don't think anyone expects that to happen, but just the wording of the Biden tax proposal, it would not eliminate it. And then lastly, potentially reduce the exemptions and the rates to so-called historic levels that applied previously, back in, say, 2009 or thereabouts. And what could that mean? Well, right now we're looking at federal $11,700,000 basic exclusion amount, which means for a married couple, and that's here in 2021. The new number, it used to be $11,580,000. Now it's $11,700,000. Married couple, you don't have to worry. You're U.S. citizens, U.S. residents. You don't have to worry about federal estate taxes if you're under $23,400,000. Historically unprecedented numbers. Now, how did we get there? Back in 2017, the Tax Cuts and Jobs Act, there was a temporary doubling of the exemptions that, in effect, those exemptions were $5 million as indexed. It was doubled. There was a slight change to the indexing regime, but it was doubled to keep it within budget limitations because it's all done as part of the so-called budget reconciliation process. There was a sunset to it after December 31, 2025, at which point there would be a reduction to the pre-Tax Cuts and Jobs Act levels, $5 million as index. So again, we're currently $11,700,000, married couple, you double that, $23,400,000. A very, very easy adjustment if the Democrats were looking to raise revenues, and for tax policy reasons, we're to say, okay, this sunset that occurs December 31, 2025, we're going to cross out December 31, 2025 and have it say December 31, 2021. I think that is probably foreseeable that we could be looking at that over the course of the next year. Could the exemptions go further? Well, again, in the Biden tax policy proposal, it talked about historical levels, historical levels. Historically, 40% rate, which is what we currently have, is very, very low. If we're looking back, turning back the clock, say, to the year 2009, and quite often that is referred to as a benchmark, we had a $3.5 million exemption for estate taxes and also for generation skipping transfer taxes. That's where wealth transfers down 2 generations, think to grandchildren, from a grandparent. However, that was for estate and GST tax. For a gift tax back then, we only had a $1 million exemption, $1 million exclusion amount. So we could be looking at that. We don't know, but those are the policies that were part of the plan. Now, something else I mentioned, could there be anything else? I think there could be. Going back to the years of the Obama administration, there was, over the last several years, a Green Book proposal that was put out, which is basically a wish list as to what the Obama administration would like to see as the tax policy from year to year. And again, President-elect Biden was the vice president back then. So I think we need to look at that and consider this as possibly being on the table. And many of the things I'm going to talk about, my colleague Shifra Herzberg will further describe the techniques that are involved, but just to set the table a little bit here. So part of the Green Book proposals from President Obama, going back to, say, 2016, include the following. Firstly, the elimination of discounts for lack of marketability in the context of family-owned entities that do not conduct a trade or business. Those were the so-called Section 2704 proposed regulations that came out in 2016 that would have wreaked havoc on many of our favorite techniques that involve discounts, at least for lack of marketability. It wasn't so clear that it applied to lack of control. Now, those proposed regulations were ultimately withdrawn. There were comments by a number of organizations, ACTEC, New York State Bar Association, New York City Bar Association, and the like. a number of groups, the American Bar Association as well. Ultimately, those proposals were withdrawn. But we could possibly see, is it foreseeable that we could see a modified version of that perhaps scales down in scope but still targets the way it did, discounts for lack of marketability in the context of family-controlled entities that do not conduct a trade or business? I think that is potentially on the table. I think that is foreseeable. It would not shock me to see that come back. Doesn't mean it will, but certainly wouldn't shock me. Secondly, we love planning with entities that have acronyms. Shifra will talk more about it, but one of those favorite acronyms is the GRAT, the Grantor Retained Annuity Trust. And as to that, basically, it's a non-gift mechanism. You put money into a trust, you take back an annuity, it has to be for at least 2 years. You could potentially zero out, have no gift tax. It could be tremendous. We're planning with valuations that are uncertain. Maybe there hasn't yet been appraisal. Wonderful technique to be able to manage that. The proposal back in the Green Book proposal in the President Obama administration would have said that you have to have at least a 10-year term for a GRAT, which means it only works if the grantor who sets it up and funds it survives for at least 10 years. And then secondly, there has to be, one of the proposals, last year's proposal, said there has to be a minimum gift component, and it would be deemed, if it doesn't occur, of at least $500,000. And that's significant if we find ourselves in an environment with drastically reduced gift tax exemptions. If you have $11,700,000, it's not too bad. It's like, so what? I'm dealing with it. That's only $500,000 of my lifetime, $11,700,000. But what if you have only $3.5 million, or what if you have only $1 million and you use up $500,000 in one shot? Very, very significant potentially. What other proposals were part of the Obama administration's Green Book? Well, also substantial restrictions on another one of our favorite techniques, sales or other transfers to intentionally defective grantor trust, IDGITs. Now, Shifra will talk more about what it is, but basically, if you try to have swaps or sales, they could result in subsequent appreciation, at least under the Green Book proposal, going back to the Obama administration. Again, nothing proposed here yet in 2021, but looking into the crystal ball as to what could happen would not shock me if that would be put on the table again. And then to provide limitations on wealth, dynastic wealth that could pass, perhaps limitations on the application of the validity of the GST exemption, generous transfer tax exemption, to limit it to perhaps to some terms such as 90 years. So that's what could potentially be on the table and the implications of what happened last week in Georgia.
Thank you, Kevin. I hope you didn't cover all the questions I have to ask here, but you'll let me know. The next question, is it possible for there to be a retroactive reduction for this state gift and generation skipping transfer tax exemption in January 1st, 2021?
Well, I think there's two different ways to look at it. Number one, is it theoretically possible from a U.S. constitutional matter? And then second, is it likely to occur? So to address the first aspect, theoretical possibility, there is Supreme Court precedent going back to the 1990s, the Carlton case, that does make clear that, well, I don't want to say made clear, because again, it comes down to what the U.S. Supreme Court says and how it gets interpreted by the current Supreme Court, but does support the proposition that you could have legislation enacted later this year, let's say it's May or June, for example, and have it apply retroactively to January 1, 2021. Example, you give away your $11,700,000 in January or in February, saying, I have this exemption right now, and then Congress enacts a law that says you only have a $1 million gift tax exemption, and you had it as of January 1, 2021. The general consensus seems to be, and I'll leave it at that, general consensus seems to be that that would be constitutional and permissible from a U.S. constitutional perspective. Put that aside. Is that likely to occur? I do not think that's likely to occur, especially with the thinness of margins in the Senate, 50-50, with the moderates such as Joe Manchin and the like. I would just think that there would be a huge outcry if among the constituency if there were to be gifts utilizing exemption only for Congress to later say, oh, you thought you had $11,700,000 to play with, $23,400,000 for a married couple? You're wrong. Retroactively, we're changing that, and you're now paying 45 cents on the dollar in gift tax, maybe generous gift and transfer tax on top of that. I don't foresee that as happening. However, it is theoretically possible.
How could one protect against the possibility of a retroactive reduction in estate, gift, and generation skipping transfer tax exemptions? And is it true that a Q-tip trust can be very useful here for married couples?
We love our acronyms. We love our acronyms. I'm going to introduce another one. So a Q-tip, Qualified Terminal Interest Property Trust, it's basically a trust that's designed to take advantage of the marital deduction. To do that, you have to have certain provisions. The only beneficiary can be the spouse. All income can be paid, must be paid each and every year to the spouse for the spouse's entire lifetime. What happens after the spouse's death? Well, that could be controlled by the grantor, but it must be solely for the spouse, and all income must be paid each and every year to the spouse for that to apply. Now, how does this enter the conversation? Well, again, the concern is that what if, again, I see it as a theoretical risk, but sometimes what if there's a transaction that folks expect to close by some date and it doesn't? And let's say Congress introduces legislation that says we're going to have a dividing line as of the date of introduction of the bill, say in the House of Representatives. And that date, let's say it's sometime in May or June. Historically, that's when these proposals have been introduced, May or June. And it's effective as of the date of legislation. The closing of the transaction that involves a gift doesn't occur until some time afterwards. The legislation gets enacted, and it keeps that same anchor date. So how can you protect against that? How can you protect against that sort of situation? Well, the way you look at it is that when you're transferring assets, you basically have two separate pots. And you set it up so that if there is an amount in excess of the exemption that you had at the time that you made the transaction, that you made the gift, or it could be a sale as well, to intentionally affect the grant or trust, to give it away, if you use up more exemption, it then goes to a protected pot. And that pot is protected by a deduction, such as the marital deduction for gift tax purposes, which could include a Q-tip trust. We'll talk about that shortly. Or it could be protected by, that protected pot could be, if you go to charity, protected by a charitable deduction. Or you could have, let's say the situation is like, I'd love to do that marital planning with a Q-tip trust. And be able to make a Q-tip election that gets filed on a gift tax return, which doesn't get filed for 2021 transaction. It gets filed in 2022 and 2022. So you have a long, long time to figure it out, and that's a big advantage of a Q-tip election. It's statutorily blessed. There is no doubt about it. There's no ability to contest. You just have to fill it out and check the box in the gift tax return to do that. And you do that next year, and it's retroactive as of the time of the transfer. So that's wonderful, okay? So you want to do that, you want to control it, but let's say there is no spouse. So again, my favorite technique when doing that is to do it with a Q-tippable trust. You could choose to Q-tip or not to Q-tip. If you don't Q-tip, utilize the exemption. To the extent you do, you have the protected pot go to the marital deduction, you get the second look that's done on the 2021 gift tax return that doesn't have to be filed until October 15, 2022. If there is no spouse, you could use charity for that purpose. Does it work? Probably should work. Again, you don't have the same statutory blessing and regulatory blessing that you have with Q-tip trust. So that would be the absolute favorite technique. But charity should work. What if there isn't a charitable predisposition? What if someone says, I just want to get it back? Well, in that case, what you probably want to do is you want to have a pour-over go to a trust with many of the same terms, but also includes one additional. One reserves what's known as a power of appointment, a special power of appointment. Usually, you want to make it an incomplete gift, it would have to be the grantor who retains it, perhaps a special power of appointment both during lifetime and at the grantor's death, that allows the grantor to redirect, including potentially to the grantor, to get it back, the excess amount. So I think that's a lot of what the planning we're going to be looking at. When there are spouses, you heard we love our acronyms. I'll add another one, the Spousal Lifetime Access Trust, the SLAT, spousal lifetime access trust. This is a variant on it because, in contrast to the typical SLAT that has multiple current beneficiaries during the lifetime of the spouse, here with a Q-tip trust, you could only have one. It could only be the spouse. Now, sometimes the question I get asked is, well, can you have something that's similar to a Clayton Q-tip in the federal estate tax arena that says that if you don't make the Q-tip election, then it's permissible, and there are regulations in the estate tax arena that says it's permissible, estate tax regulations under Section 2056, that says that you could then have it pour over to a trust as multiple beneficiaries, not just the spouse, but other beneficiaries as well. There is no corresponding authority in the gift tax area, in the Section 2523 gift tax regulations. I think the general sentiment is don't try that without a private letter ruling, and probably don't try it at all, because there's, again, no regulatory support. There was a case that preceded that, the Clayton case, that's why it's called the Clayton Q-tip, in the federal estate tax arena, would not try that in the gift tax context. So those are my thoughts on how to protect from retroactivity.
Great. The next two questions are for Shifra, but Kevin, you can feel free to chime in as well. Shifra, what are some estate planning considerations that advisors should be aware of now, taking into account this uncertainty?
So, we've been saying in this field for a number of years that, the future of the estate tax is uncertain. You should plan now. And I feel like, I've been repeating the same line for decades. But now what I've realized is that everything that we've been saying is now so much worse. The uncertainty is not just what the future of the estate tax will be, what the actual impact of anything that you do this year will be, which definitely makes it that much more complicated. To the extent you have clients willing to take the risk that no changes are actually retroactive, there's a number of popular vehicles, as Kevin mentioned, such as the SLAT, that were being used through the end of last year. So you can transfer assets to a trust, you have a spouse as a beneficiary, a spouse a lifetime access trust, and that hedges against the risk that the person loses access to the assets. Distributions can be made to a spouse so that the person can still retain some beneficial interest effectively through their spouse's interest, and can make significant gifts. With the current exemptions as high as they are, you can really take advantage of these while you still have them, if you still have them. The problem is, as much as it hedges against the risk of losing access, it doesn't hedge against the risk of there being a tax to be paid to the extent that actual legislation is retroactive. As Kevin mentioned, you can use, formula clauses with spillovers so that to the extent that anything goes above exemption amounts as they're available, they go to a deductible place. So if you have a spouse or a charity that you can use, you can definitely use those. As well as, an incomplete gift trust to try and hedge against those risks. But the IRS has also been contesting formula clauses, and there's always some risk related to the formula clauses as well as to whether or not they'll be respected, particularly when there's such a stark difference between, if the exemptions are reduced retroactively, there's going to be a really stark difference between the actual amounts that are being transferred up front and the amounts that the formula will say is transferred. So, you transferred $11 million up front. If you have a 1 million exemption, you're actually only transferring $1 million. There's a lot of room for the IRS to go after that for significant tax revenue. So it's definitely difficult. So there's some other strategies that people have been looking at to try and plan in the face of this uncertainty to hedge against the risk of tax. One of the other ways that Kevin mentioned, the Q-tip planning, is a great strategy that's clearly blessed, in terms of the tax code. You can make a Q-tip election, a partial Q-tip election. You get the benefit of the marital deduction. The downsides are, one, you need a spouse. Two, the assets are held only for the spouse. So for the spouse's lifetime, if you have a second marriage situation, it's going to be a lot less appealing to have these assets held for the entire spouse's lifetime. If you have, if you want assets to be able to pass to kids, and they're also somewhat leaky in that the income has to be distributed annually. So you lose the benefit of the income being held outside of the taxable estate because that all comes back to the spouse. So it comes back to the spouse where it's includable in the taxable estates again. So there's definitely upsides in that, you don't necessarily want to take the risk of a huge gift tax to be paid in millions of dollars, but, and it is likely worth it from the income leak perspective. But there's definitely downsides as well. Other options that are being talked about a lot, but are a lot less blessed in terms of there being, as much history on them and as much law on them, is disclaimer planning. So you transfer assets to a trust, The trust provides that if the beneficiaries, so it could be spouse, it could be kids, but if the beneficiaries disclaim the assets within the 9-month time frame, so it has to be a qualified disclaimer. If the beneficiaries disclaim the assets, it can provide that the assets actually go back to the donor or go back to the donor's spouse. Since qualified disclaimers are treated as having been made effective as of the date of the initial transfer, it'll be treated as if no gift was made. You know, it came back, there was no transfer made or a full marital. The transfer was made solely to a spouse. The problem is it definitely has less law associated with it. It also only gives you 9 months of the time frame. So hopefully within 9 months from now or 9 months from the date the transfer is made, we actually know the impact of legislation. So to the extent that the exemptions are reduced retroactively, the disclaimer would be made. You want to make sure that you have beneficiaries who are available and able and willing to make those disclaimers so that you're not put into a bad position there. There are also risks that you have to carefully review. Any kinds of implied agreement with the beneficiaries up front could be an issue. If there's, if whether or not it's viewed as a complete gift in terms of any kind of agreements like that, any potential acceptances of benefits by the beneficiaries, if these are trusts that are making distributions, if beneficiaries are using any kind of the assets, there are risks that can come into play there. And again, it's just not as well tested. There are also other strategies that you can use that are tried and true and have been tested historically. So as Kevin mentioned, the GRATs are actually a really good option in this kind of scenario, a grantor retained annuity trust. A GRAT is basically a trust where the grantor transfers assets. The grantor receives back an annuity. The annuity is equal to the value of the assets transferred plus an IRS assumed rate of appreciation. It's the 75/20 rate. The current IRS assumed rate of appreciation that the grantor would get back is 0.6% for January. So it's an extremely low rate. If the assets in the trust appreciate above that rate of appreciation, you're going to have a benefit. You're going to have assets appreciating outside of the taxable estate. The upside of a GRAT in this kind of environment is that there's no taxable gift being made. So you don't have to worry about use of exemption and potential gift tax because the assets are the value that's initially transferred comes back to the grantor. It's just the appreciation. It's a freeze transaction. It's just the appreciation that's outside the estate, but you don't have to worry about a gift being made with potential tax on that gift. The other benefit of GRAT is you can transfer assets that have valuation discounts to it. You always need to keep in mind, to the extent you transfer assets with valuation discounts on the way in, if you need to use those same assets to pay the annuity, the same discounts will apply on the way out. But if there's cash flow from the assets being transferred, that can be used to pay the annuity, and you can get the benefit of leveraging the value of the assets being transferred through the discounts. But a big upside in this environment as well is that, let's say the discounts go away. As Kevin had mentioned, we're concerned that based on the Obama proposals, there may be some changes in legislation that disallow certain discounts. GRATs can self-adjust. So the value of the annuity that's coming back can be based on the fair market value as determined for gift tax purposes, the fair market value of the assets that went in. So if the IRS says no discounts available, we are determining the value of the assets to the trust to be greater without a discount. The annuity that comes back just adjusts itself to take that into account, and so that you still don't have a gift that's being made. So you don't have to worry about a potential gift, even with those kinds of changes to legislation later, and even if those are retroactive. This is particularly also a good vehicle in a volatile market, because the point of a short-term GRAT is to capture short-term upswings in a market. And so when the market's going significantly up and down, when you have an upswing, you could potentially substitute assets out, capture that upswing within the GRAT in a short-term time frame. And so while this volatile market right now has not necessarily been good for our heart rates, it has been actually very good for GRAT planning. So it actually works very well as long as the short-term GRATs are available. You might think that GRATs have always been around, and even if the exemptions go back down, they'll continue to be around. But as Kevin mentioned, it's also something you might want to do sooner rather than later. If you have a 10-year time horizon, it's going to significantly impact the upside that you can get out of it, as well as a minimum taxable gift. But even without a taxable gift element, a 10-year upside, a 10-year time horizon really does change them. Another similar, oh, sorry, Jonathan, did you want to say something?
No, I thought you'd keep going. You're on a roll.
Another similar strategy that Kevin also mentions, again, you might want to do sooner rather than later, because based on the Obama proposals, we don't know that those will come back, but we've seen them before. Sales to grantor trusts. A grantor sells assets to trusts in exchange for a promissory note. The promissory note bears interest at the applicable federal rate. It's also a freeze transaction. So as long as the assets in the trust appreciate above the applicable federal rate, you're going to have a benefit and an estate tax benefit in assets appreciating outside the estate. The current applicable federal rates are also extremely low. A 9-year note is at 0.52%. It's 0.5%. So as long as the assets in the trust appreciate above that, it's worthwhile to do. The other benefit of sales is that you can actually allocate GST exemption, which you can't do with grants, because with a grant, you can't allocate GST exemption until the term ends. And by the time the term ends, you may not have any GST exemption left if the exemptions go away. A sale to a grant or trust, you can use a pre-existing trust if you have one, or a new trust that you fund below what you think the exemptions might be at whatever level your client is willing to take the risk of what the exemptions might be. And you can actually allocate GST exemption just to the value gifted, and everything that's sold, you don't need to allocate GST exemption because it's a sale for fair market value. And the other thing is that, again, if discounts go away, you can sell assets for discounts, and you can have purchase price adjustment clauses. So what the sale documents can say is that the purchase agreement will say the purchase price is the fair market value of the assets as finally determined. If the IRS still, if we still can have valuation discounts, the fair market value will take into account those valuation discounts. But to the extent that the valuation discounts go away, the purchase price will self-adjust. So again, no gift, so that you don't have to worry about use of exemption when you may or may not have that exemption that's available. So the proposals to take away the benefits of sales, again, could actually cause inclusion in the estate. So those are also things that, again, you may want to implement sooner rather than later, even though they're not necessarily using exemption, and it's not necessarily based on the exemption. We really just don't know what legislation we may see, and that legislation may exist in the near term. There is one more really straightforward one that actually could still provide some real benefits that I thought it worth mentioning, which is actually a grantor can just make a loan to a grantor trust, a straight loan. You transfer assets to a trust at the current applicable federal rates. The trust can invest those assets, and if it invests and earns appreciation on those assets above the current rates, again, they're at historic lows. A 3-year note, the short-term rate, 0.14%. If those assets appreciate above that rate, you've transferred assets outside the taxable estate. You've made no gift. You want to make sure, again, you have bona fides of the loan, that is not treated as an imputed gift. But if you really respect the loan transaction, it's actually the most straightforward way. Again, no use of exemption, so no real risk. It's certainly a tough time to make decisions when it comes to estate planning. But we just thought those were a few thoughts to sort of hedge that risk and the uncertainty that currently exists in terms of the structure that you're taking into account.
Great. Shifra, another one for you. What are some general considerations that are helpful in the current COVID environment?
Yeah, so as much as we can talk about all of the tax strategies and the thoughts in terms of the tax legislation, we are still in the midst of a pandemic, and it is still very important to make sure that people's basic documents are also in place. Hopefully we've done this within the past 10 months or so, but you never really know. So people's healthcare proxies, again, in the midst of this kind of environment, you want to make sure they're up to date. Powers of attorney, I just wanted to note that actually New York has amended its power of attorney law. The governor actually signed it in December. The changes go into effect in June. So the changes actually make the powers of attorney overall more flexible in that you can have substantial conformity instead of a strict compliance type of standard for the format of the power of attorney. The new law gets rid of the gifts rider, which is actually, you can put any gifting authority into the modification section of the power of attorney. When you get rid of the gifts rider, you get rid of the 2 witness requirements, technically speaking, but there has been an agreement that is going to implement the 2 witness requirements. So I would not start executing powers of attorney without your witnesses there. And again, this doesn't go into effect till June. All your current powers of attorney are fine. You don't need to worry about those. The other nice thing actually about the new law is that it has enforcement mechanisms. So you can actually have a financial institution that refuses to honor a validly executed power of attorney can actually be subject to damages, which until now, when financial institutions refuse to honor them, it's been very difficult because you have to argue with them, but there wasn't really much way to actually enforce it. And now there's actually a potential for damages. And so the other thing to keep in mind with your powers of attorney is that you want to make sure they provide for any gifting authority and any authority for disclaimers, as an example. If you want to be able to implement planning with this current environment, make sure that what your current powers of attorney under current law and using the current forms provide for the authority to make disclaimers, the authority to make gifts. The authority to fund revocable trusts, and that's another thing I wanted to quickly talk about. What we've noticed in a trend is that, while the field in New York was really split in terms of using full wills and wills that pour over to revocable trust, we have definitely been seeing a much more significant trend to using revocable trusts. When the courts were closed for months and with the delays due to COVID, what we've realized is that the delays can be much more significant than they were historically. And so you want to make sure that any clients who need to have access to assets and be able to invest them, even if something happens to them on a short-term basis, you want to make sure that they both create a revocable trust and fund it, and that the powers of attorney permit the creation and the funding of those kinds of trusts as well. So that, those are all options that are available. And because remote witnessing and remote notarization is still available by executive order renewed every month, which we anticipate continue to be renewed while we're in the current environment, you can actually get these documents implemented and executed without anyone being put at risk or coming to any place where they're not comfortable. You can do it all virtually as long as everyone's located in the state of New York. And since people may not be, you'd have to look at the remote execution of the relevant state. New York, you are required to have everyone located in New York. And as New Yorkers, some of them have fled in these cold winter months. But there should be options that are available to get things executed and implemented.
Great. What is the potential impact of President-elect Biden's election and the Georgia Senate runoff elections on qualified opportunity funds and opportunity zones?
Oh, that's a very good question, Jonathan. So let me just set the background here. So qualified opportunity funds, opportunity zones, that came in with the Tax Cuts and Jobs Act back in December 2017. And interestingly, that was the one provision, the sole provision of the reconciliation process that was also had Democratic support. It's going back quite a ways. The thought was, how can we use the tax code to engineer and to encourage investment in economically distressed communities, think inner cities. It doesn't have to necessarily be parts of cities. Call them opportunity zones. And the thought was, and it was sponsored not only by Senator Tim Scott, Republican from South Carolina, but also by Cory Booker, Democrat, of course, from New Jersey. So both Republicans and Democrats, was that we could take capital gains and allow people the optionality, taxpayers the optionality to say, you don't necessarily have to pay tax on the capital gains right now. If you were to invest it with 180 days or 180 deemed days in this new vehicle, the tax code that we're going to call a qualified opportunity fund, we're going to give you a trio of tax benefits that you can to motivate you to do this, to encourage investment in these opportunity zones, which are in turn invested in by the qualified opportunity funds, usually through second-tiered entities. The rules are just much more advantageous if you have two different layers of entities. But to encourage such investment, we're going to give you three big benefits. Number one, if you do it within 180 days or 180 deemed days of your capital gain, we're going to allow you to defer having to pay tax on that capital gain until the earlier to occur of a disposition of your investment in the qualified opportunity fund, or as an outside date, I like to refer to it as the judgment day, December 31, 2026. So you get to defer your gain all the way down the road, potentially December 31, 2026, unless it's an earlier disposition. No interest whatsoever on the deferral. Time value of money, that's a huge benefit right there. Second big benefit of the Qualified Opportunity Fund legislation, again, Tax Cuts and Jobs Act of 2017, in addition to deferral, will allow you, taxpayer, to potentially have some of your capital gain disappear. and be eliminated. If you happen to hold the investment for 7 years through December 31, 2026, which means you must have invested by December 31, 2019 to do that, we'll give you potentially a 15% basis step up. You start out with 0 basis, 15% basis step up on the amount that's invested, potentially eliminate 15% of the gain. For those currently, we're now talking about a 5-year hold through December 31, 2026. And as to that, there's still a very robust 10% step up in basis. The way the rules work is you start out with a 0 basis, you get a 10% step up, that eliminates 10% of the gain. So that's very, very significant. And then because the overriding goal here was not just short-term investing and getting it out and maybe getting it out in like 5 or 6 years or 7 years, but very long-term holds. There's a further provision in the tax code that deals with qualified opportunity funds that says that if you happen to hold your investment for 10 years, and let's say there's very, very substantial appreciation that occurs, all that appreciation that occurs will avoid tax. So very, very significant. Now, again, this was supported, the one provision, the Tax Cuts and Jobs Act, that had bipartisan support, okay, not just by the Republicans, but also by the Democrats. So what has President-elect Biden said about it? Now, President-elect Biden has supported it, supports maintaining the benefits, the trio of benefits I just mentioned for qualified opportunity funds, but he has called for some reform, okay, as far as regulations to assure that the funds actually do benefit underserved communities, economically distressed communities, and also to prevent abuses. So what would I foresee there as a consequence of the incoming administration? Just, I guess, again, today is January, just for the record, for the recording, today is January 12, 2011. The Biden administration comes in, and the composition of Congress will change come January 20th, which is only 8 days away. I would expect the opportunity zones, qualified opportunity fund legislation to be retained. However, I would expect there to be further reforms and further tightening, both administratively and also perhaps through legislative action, to provide for greater monitoring and to make sure that the amounts that are invested, for which the trio of benefits I just described, ultimately are funneled into the economically distressed communities. Now, again, there's lots going on here. Not only do we have COVID, but we have the recession and the like. We had the Great Recession of 2008, 2009. This is the greater recession, whatever you want to call it. It's the next step above that. So there has been various items of emergency relief, such as declarations. There was guidance that was provided back in June of this year, which I've written about, which provided a great deal of relief in the Qualified Opportunity Fund area, including maybe there could be a 24-month extension if you have a second-tiered entity and meeting a certain harnessing of working capital type exception for the actual deployment of funds into buildings or other projects. Or it could also be operating businesses. It doesn't just have to be real estate. It could also be operating businesses that are located in the opportunity zone. Again, there's Treasury regulations that have indicated how you do that. But I would expect there to be further reporting standards, maybe a crackdown of perceived abuses, additional reporting on the IRS tax forms that are required, and ultimately a report that gets submitted to Congress as to, and maybe a couple years down the road, but ultimately reports on the successes of the legislation.
Kevin, I understand that the U.S. Department of Treasury just last Thursday issued final regulations under Section 1061 of the Internal Revenue Code addressing certain income tax issues that apply to carried interests in private investment funds, and that you were involved in the American College of Trust and Estate Council's comment letter project on it. Can you please describe how these final regulations impact estate planning with respect to carried interests?
So let me unpack that. And this is a brand new development. So that this came out, we have final regulations under Section 1061 that came out literally last Thursday. So what day was last? I've already lost track. What was that? January 7th here in 2021. So we're now only 5 days beyond that. And what those regulations did, well, just to unpack it. So again, I talked about Tax Cuts and Jobs Act. We talked about Qualified Opportunity Funds. This is another provision, the Tax Cuts and Jobs Act, that deals with so-called carried interest of private investment fund managers. And those are clients that usually wealthy individuals who are fund managers who have an interest in the general partner. Both Shifra and I have a number of them among our client base. We do a lot of work for them. And an issue that's been presented is, well, the special treatment that fund managers receive for their so-called carried interest, and I'll unpack that in a second, explain what that is for the audience, that allows that carried interest to be treated as capital gain property. And if held for more than 1 year, any gain on disposition or amounts received in respect of it is to be treated not as ordinary income, which is subject to the ordinary income tax rates, currently 37%, but rather taxed as long-term capital gain, which are subject to a maximum tax rate currently at 20%. Again, we could be seeing a proposal to increase that for folks above $1 million to possibly as high as 39.6%, but to treat that as the importance, the primacy of treatment of long-term capital gain, at least under current law, is very, very significant. The concern that results in this legislation that dealt with this, that was manifest in Section 1061 of the Internal Revenue Code in the 2017 Tax Cuts and Jobs Act, was, well, if you have a fund manager, they usually have different revenue streams. One is by virtue of being providing management services through a fund management vehicle, and as to that, there are payments of compensation that are treated as ordinary income. Okay, so that we have that. But then we also have another stream, which is designed to capture the hopefully outstanding performance and return on investment in the fund. And there's usually, the way the fund agreements are structured is that there will be a general partner that holds the interest under the fund agreements that gets that additional interest. And that interest is called a carried interest. The way it quite often works, and it varies from fund to fund, is you'll have an amount, maybe 2% of the amounts on an investment paid to this fund management vehicle. Put that aside, that's ordinary income. But as to this carry, it's that this carry interest, you'll have the general partner receiving an interest in the fund that says that if there's a return above a benchmark level, it could be 8% return on investment, 9% return on investment. After that, perhaps after certain makeup provisions, there will be an allocation, a super allocation that then goes to the general partner. Perhaps 20% of return on investment profits above that benchmark, 8% or 9%. That all goes to the general partner. Quite often our clients, fund managers, will have interest not only in the fund management vehicle, but will also have interest in the general partner. And the concern that has been voiced over the last decade and a half, I would say, is that cash flow attributable to the carry, well, it's being paid to people who are providing services to the fund. Isn't that of the nature really of ordinary income? And should it not be taxed as ordinary income instead of being taxed as long-term capital gain, which has all the benefits, potentially, as you mentioned, long-term capital gain rate, 20% as opposed to 37%. Very, very significant. So there were proposals going back to about nearly 15 years ago that said, treat this as ordinary income. Well, Congress did not do that. What Congress did basically as a compromise, revenue-raising measure, in 2017 Tax Cuts and Jobs Act, because they had to provide certain offsets to raise revenues, but the question is, how far do you go? They said, okay, if you're a fund manager in this and have this so-called applicable partnership interest, called, we love our acronym, API, and you have this interest, we're going to respect the fact that it's long-term capital gain. However, we're going to change the holding period for you. Instead of the general rules that say that you cross over from short-term capital gain, which is taxed the same way as ordinary income, to long-term capital gain of being a one-year holding period for that, we're going to say that if you have an interest, an applicable partnership interest in basically a fund, think in terms of a hedge fund, private equity fund, also be a real estate fund, we're going to change this one-year holding period to 3 years. We're going to change it to 3 years. And if you hold the interest for less than 3 years, you're then going to have you're going to be treated as having short-term capital gain instead of long-term capital gain. And again, short-term capital gain gets taxed just effectively on a net basis, taxed like ordinary income. That was a bargain that was struck in the Section 1061 in the Section 1061 statute that came out in 2017. Now, also in that statute was a provision that said that we're going to deem to occur certain transfers, and that if you have a transfer to a related person, we're going to basically say that's going to be a realization event and will be a trigger event as well. It's in Section 1061D. So that sets the backdrop. Treasury was silent on that until July 31 of 2020 when it came out with proposed regulations. And those proposed regulations provided some further context and gave us a great source of worry. Basically, what the proposed regulations say that acceleration provision and the way it impacts estate planning, having now unpacked it and explained the context, is that if you make a transfer, and the transfer is not to a disregarded entity, okay, rather you make a transfer and say it is to a certain related person as defined specifically under a nuanced provision in the tax law, basically to a child, to a grandchild, to a spouse, or to a parent, directly or indirectly within the 3-year period. It could be by including not just by sale or exchange, but it could also be through other means, such as by gift. You make a gift to a child within a 3-year period, or it could be, again, it could be a spouse or a parent or a grandchild. That's going to be an acceleration event and will cause the capital gain attributable to the carry to be realized then and be a taxable event. Now, the way the proposed regulations were worded, it talked about directly or indirectly. And just parsing the language, there was concern. I can tell you the ACTEC had the concern, and also the American Institute of Certified Public Accountants, the AICPA, had the concern that if you have a transfer, not to a grantor trust, because grantor trust was specifically blessed as a transfer disregarded entity. Again, as Shifra mentioned, we love our grantor trust in estate planning, and it applies here in the context of planning with carried interest for private investment fund managers as well. But if you have a transfer to a non-grantor trust, the concern was that could be treated as an indirect transfer for benefit of the certain related parties under Section 318A1, the children, the grandchildren, the parents, or the spouse, and that could be a triggering event. Number of organizations, including ACTEC, American College of Trust and Estates Council, AICPA as well, submitted comment letters saying that this doesn't seem to be what Congress was after. Please provide clarification. Please provide clarification that if we have such transfers, it's not going to be a taxable event, including when it's a transfer to a non-grantor trust. There also was requests for clarification concerning certain family office transactions that involving related parties and did not involve third-party investors who were unrelated to the transferor. Think in terms of family office type entities. So we finally, well, I don't want to say finally, because actually Treasury moved rather quickly on this. In ACTEC, I was involved with a project with a wonderful group there, and we submitted our comments on October 5th. We just received comments again last Thursday, January 7th, so that is very fast by U.S. Department of Treasury. And the responses in terms of the final regulations were extremely helpful, and basically granted what the various organizations were asking for with regarding transfers. The final regulations do is they say that we're going to read the statute differently than we did in the proposed regulations. We're going to cut back where it said that it also applies to gifts. We're taking that out. It only now applies to sales and exchanges. The proposed regulations talked about it applying to gifts. It also talked about it applying to contributions or distributions. Now, what about distributions from trust, out of via grantor trust or non-grantor trust? The final regulations completely eliminate that and say that that there's no longer going to be an acceleration on anything that's not a sale or exchange, and they specifically define transfer as solely a sale or exchange, which means It would not apply to gifts, would not apply to death, would not apply to contributions, would not apply to distributions. All very significant. Now, could there be permutations on that? If you have a distribution and or if you have a contribution with debt in excess of basis, or something that would otherwise be subject to tax under partnership tax rules or corporation tax rules that applies. Probably won't have would not have corporations context, but under partnership tax rules or under trust rules, could there be, and that doesn't involve a grant or trust, could there be a taxable event, a triggering acceleration? Possibly. That is still being reviewed, and that is possibly an open area of exposure. But the primary concerns as to having gifts be subject to this regime of tax, and to have an acceleration regime that could apply to gifts or other transactions that are not sales or exchange, completely by the boards now, and seems to have been eliminated in the final regulations that came out last Thursday.
Great, thank you. And actually, it looks like we're at time. So, and I like to be punctual, and I want to make sure everyone can get back to work in time. So thank you, Kevin and Shifra. If anyone has any specific questions, new business opportunities, any other issues they'd like to discuss, please feel free to reach out directly to Kevin, Shifra, or myself where appropriate. I'll include their contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Two more items, quick items before I let you go. Immediately following this program, there's a one-question poll. The question is, in light of the Democratic sweep, are you more bullish or bearish on the markets and the economy, or does it not matter? We have a large national audience on this program, some who watched it live today, another 100 or 200 who will watch it, the recording later. Be interesting to hear people's thinking. And if you want to know my thoughts, I wrote 2 articles, one in Trust and Estates and one in the Wall Street Journal on this very topic, if you want to cheat. I will share the results to that poll at my next program, which brings me to my final item. My next webinar is on Thursday, February 4th, entitled Important Medicaid and Elder Care Update, New Major Changes to New York's Home Care Program, featuring Elizabeth Forspan of Forspan Clear, based in Long Island, New York. Tomorrow, send the registration information to this and all of my upcoming programs, and I hope you can attend. And with that, this concludes today's session. Please stay safe and healthy. Have a wonderful day, everybody. Thank you.
Bye, everyone.
Thanks, everyone.
Thank you, Jonathan.